Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Prestige Consumer Healthcare Inc. quarterly report. Prestige Consumer Healthcare Inc. offers a diverse range of over-the-counter, OTC health and personal care products through its two main segments, North American OTC Healthcare and International OTC Healthcare. The company's product portfolio includes analgesic powders under the BC and Goodies brand, as well as various treatments for diaper rash, skin protectants, sore throats, and mouth pain. Additionally, Prestige Consumer Healthcare provides eye care products to relieve redness and itchiness, at-home wart removal solutions, and ear wax removal products. The company also offers dental care products under the DenTech brand, including dental guards, floss picks, interdental brushes, and tongue cleaners. Other notable brands include Dramamine for motion sickness relief, Fleet for enemas and laxative products, Gaviscon for stomach upset remedies, and Luden's cough drops. Furthermore, Prestige Consumer Healthcare provides feminine care products under the Summer's Eve brand, including washes, cloths, and sprays. The company also offers lice and parasite treatments under the NYX name, as well as oral rehydration products under the Hydralyte brand. In terms of distribution channels, the company sells its products to mass merchandisers, drugstores, food stores, dollar stores, convenience stores, club stores, and e-commerce platforms. With a presence in North America, Australia, and internationally, Prestige Consumer Healthcare Inc. has established itself as a leading provider of OTC health and personal care products. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any company can be influenced by various factors that impact its financial performance and reputation. Some common reasons for a decline in stock price include poor earnings reports, decreased revenue, increased competition, regulatory issues, and negative publicity. Additionally, changes in market trends, economic downturns, or unexpected events such as natural disasters can also contribute to a drop in stock value. In the case of Prestige Consumer Healthcare Inc., it is likely that a combination of these factors has contributed to its declining stock price over the past year. However, without access to specific information about the company's performance and market conditions, it is difficult to pinpoint the exact causes of the decline. Investors often look for companies with strong financials, innovative products, and effective management strategies. When a company fails to meet these expectations, its stock price can suffer as a result. Furthermore, changes in consumer behavior, shifts in market demand, or increased competition from new entrants can also impact a company's performance and stock value. Ultimately, the decline of Prestige Consumer Healthcare Inc.'s stock price is likely due to a complex interplay of factors that have affected its financial performance and reputation over the past year. Prestige Consumer Healthcare Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Prestige Consumer Healthcare Inc. trades at a higher price-to-earnings ratio of 18 times and a lower price-to-book ratio of 1.72 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a comprehensive analysis of various factors. On the one hand, revenue growth is driven by strategic acquisitions, expansion of brand portfolios through new product lines and advertising support, increased spending on advertising and marketing strategies, improved packaging and formulations, and new sales and marketing approaches. On the other hand, revenue decline is attributed to economic uncertainty, high inflationary environments, geopolitical events, trade restrictions, and shifting consumer purchasing patterns towards online platforms. Additionally, rising input costs and shortages of raw materials also contribute to revenue decline. Segment-specific drivers reveal varying trends across different regions and product categories. In North America, the OTC healthcare segment experienced a decrease in analgesic sales, but an increase in oral care products. Conversely, the international OTC healthcare segment saw a significant drop in eye and ear care sales, but a notable rise in women's health products. These findings highlight the complexities of revenue growth and decline, influenced by a range of internal and external factors. Companies must carefully navigate these drivers to maintain or improve their market position and revenue streams. The net income and profit margins of a company underwent significant changes between Q3 2024 and Q3 2025, as well as YTD 2024 and YTD 2025. The net income decreased by $28,104,000 from $164,477,000 to $136,373,000. This decline in net income was accompanied by a decrease in profit margins, with the gross profit margin dropping from 55.8% to 55.6%, and the operating income margin decreasing from 31.4% to 29.1%. The reasons behind these changes are multifaceted. One contributing factor is the increase in operating expenses, including depreciation and amortization, as well as stock-based compensation costs. Additionally, there was a decrease in accounts receivable and inventories, which may indicate slower sales or reduced inventory levels. Furthermore, an increase in accounts payable suggests that the company's suppliers are being paid more slowly. The impact of these changes is evident in the financial statements. The amortization expense increased significantly from $4.2 million to $13.3 million for the 9 months ended December 31, 2025. Moreover, impairment charges of $12.5 million were recorded in March 31, 2025 financial statements, further contributing to the decline in net income and profit margins. Overall, these changes indicate a challenging period for the company, with decreased profitability and increased expenses. To mitigate these effects, the company may need to reassess its operational costs, inventory management, and accounts payable practices. The company's financial performance indicates a healthy trend in its ability to generate cash from its core operations. According to the data, the company has consistently produced positive operating cash flow over the past 2 years. In 2024, it generated $189,667 in net cash provided by operating activities, and this figure increased to $214,786 in 2025. This upward trend suggests that the company's operational efficiency is improving, allowing it to generate more cash from its core business activities. The company's debt level and interest expenses have undergone significant changes over the years. Initially, on page 26, the debt level increased from $1 million to $1,033,547. However, by page 3, it had decreased to $992,357. This trend of fluctuation continued with no significant change observed on page 42. On a more positive note, the interest expenses have consistently shown a downward trend. On page 2, there was a decrease of $783, 6.9%, and $5,962, 16.2%. Similarly, on page 17, it decreased from $37,427,000 to $33,327,000. This reduction in interest expenses continued with a decrease of $0.8 million on page 42. The most notable change was observed between 2024 and 2025, where the debt level decreased from $1.1 billion to $1 billion, and the interest expenses dropped from $36.9 million to $30.9 million. Overall, while there have been fluctuations in the company's debt level, the interest expenses have shown a consistent decline over the years. The financial performance of various segments and regions has been mixed. In the OTC healthcare segment, North America has been a standout performer, with a significant increase in contribution margin of 26.4% in 9 months ended December 2025 compared to the same period in 2024. The oral care category within this region also saw an impressive growth of 18.3%. On the other hand, international OTC healthcare performed poorly, with a decrease in contribution margin of $5.9 million, or 10.7%, in 9 months ended December 2025. In terms of regions, North America has been a strong performer, with good performance in both 3 and 9 months ended December 31, 2024. However, international markets, excluding Australia, have struggled, with no specific information provided on their performance. The eye and ear care segment has also underperformed, with significant decreases in sales in both North America and international regions. Overall, while some segments and regions have shown strong growth, others have faced challenges that need to be addressed. Management is projecting a cautious outlook for the company's future performance. Despite this, they are committed to growth through strategic acquisitions and organic expansion. To adapt to changing consumer behavior, the company is investing in e-commerce channels. The management team acknowledges that economic conditions will remain uncertain, which may pose challenges to their plans. However, they are taking steps to mitigate these risks by diversifying their financing sources. They also recognize potential disruptions in the global supply chain and third-party manufacturers' issues as key concerns that could impact demand and operations. The company's financial activities have been focused on share buybacks in recent periods. As per the information provided, the company has a share repurchase program with an authorization of $300 million. This indicates that the company is actively engaged in buying back its own shares. In fact, it can be confirmed that the company has indeed bought back shares during the 3 and 9 months ended December 31, 2025. Furthermore, a clear statement on page 48 explicitly states, "bought back shares." Yes, this confirms that share buybacks have been a part of the company's financial strategy in the specified period. That concludes the financial summary for Prestige Consumer Healthcare Inc. Feel free to comment below, and I will be happy to answer them when possible.